Lock your screen. Turn off notifications. Close every distraction, because what I am about to show you will fundamentally change how you see the silver market. The financial press is feeding you narratives. They're giving you surface explanations. They're pointing at symptoms while the disease spreads underneath. Ladies and gentlemen, Asian Guy here, and you are witnessing absolute carnage on Friday, January 30th, 2026. Silver is trading at $98.46 per ounce right now. Gold is at $5 out of $25.10. That is down $17 from yesterday's close for silver. That is down $353.90 for gold. While most of America was sleeping, the dollar weapon fired again, and this time it obliterated everything in its path. Silver has crashed 14.73%. Gold has plummeted 6.58%. Platinum is down 14.41%. Palladium has collapsed 11.23%. This is not a correction. This is a liquidation event. This is the cascade I warned you about yesterday. And if you do not understand why this happened while you were asleep, you will get destroyed again when the next wave hits. The price you are celebrating is the decoy. The real battle, the absolute carnage that determines whether or not you survive the next 30 days, is happening in a place most retail traders never look. While you watch silver climb, a hidden weapon just fired. And when that weapon strikes again, it will erase portfolios in minutes. Over the last 24 hours, we have witnessed multiple $1 trillion evaporate from global markets. Yesterday, silver crashed from $121.76 down to $69.80. Gold collapsed from $5,596 down to $516.60. Then silver recovered to $117.29 by yesterday evening. Most traders thought the worst was over. They thought they had survived. They were catastrophically wrong. While America slept, while New York was closed, the Asian session opened and the dollar weapon fired again. Silver crashed from $118.58 down to $95.18. That is a $23.40 collapse. That is a 19.7% plunge in the overnight session alone. Gold dropped from $5,452 to $4,943.90. A $508.10 massacre. If you were holding leverage positions, if you had stop losses set, if you thought $100 was the floor, you got annihilated. Your positions were liquidated while you were asleep. You woke up to margin calls. You woke up to account wipeouts. You woke up to financial devastation, liquidation cascades, margin calls, triggering more margin calls, leverage positions obliterated, and almost nobody understands why it happened because they are watching the wrong chart. They are tracking the wrong variable. They have no idea that their fate is controlled by 3 letters, DXY, the dollar index. This is not about inflation expectations. This is not about industrial demand. This is not about Chinese export controls or solar panel manufacturing. Those are secondary variables. The primary force, the invisible hand, that dictates whether silver goes to $150 or crashes back to $80 in the next 2 weeks, is the strength of the United States dollar. And right now, that dollar just weaponized itself. The seesaw just tilted. And if you do not understand the mechanics of what I am about to explain, February 1st will destroy you. Let me take you inside the machine. Let me show you the relationship that the institutions use to front-run retail. Every single time. Because the pattern is so clean, so mechanical, so reliable that once you see it, you can't escape it. Gold and silver are priced in dollars. This is the foundation. When the dollar strengthens against other major currencies, the euro, the yen, the pound, the Swiss franc, it takes fewer dollars to purchase the same ounce of silver. The price in dollar terms falls. When the dollar weakens, it takes more dollars to buy that same ounce. The price rises. This is not correlation. This is mechanical causation. Think of a seesaw in a playground. One side holds the dollar, the other side holds precious metals. When the dollar falls, metals rise. When the dollar side rises, metals fall. They cannot both ascend simultaneously. The physics do not allow it. This is why professionals do not just monitor silver charts. They obsess over the DXY. They track the dollar index every single hour. Because the DXY is the leading indicator. It tells you what silver will do before silver does it. The dollar index measures United States dollar strength against a basket of 6 major foreign currencies. The euro has the largest weighting at 57.6%. The Japanese yen accounts for 13.6%. The British pound is 11.9%. The Canadian dollar is 9.1%. The Swedish krona is 4.2%. And the Swiss franc rounds it out at 3.6%. When these currencies weaken relative to the dollar, the DXY rises. When they strengthen, the DXY falls. And because silver and gold are globally traded commodities priced in dollars, their value inversely tracks this index with remarkable precision. Yesterday, the DXY spiked violently during New York trading hours. The dollar surged in strength and silver got crushed from $121 to $16. Then, overnight, while America slept, The DXY spiked again, this time even harder. The Asian session saw massive dollar buying. Yen weakness, euro collapse, and the seesaw tilted with devastating force. Silver plummeted from $118 to $95, the overnight low. Retail traders who only watch silver candles never saw it coming. They bought the recovery yesterday evening. They thought $107 was safe. They chased momentum. They added leverage. And then, while they were sleeping, the floor disappeared beneath them. Their stop losses got triggered in the dead of night. Their positions got liquidated automatically. Their capital transferred to someone else, someone who was watching the dollar, someone who knew the crash was coming because they saw the DXY pump in the Asian session first. The institutional traders have algorithms that monitor DXY movements in real time. When the dollar index moves beyond certain thresholds, automated selling programs trigger in precious metals markets. This creates the cascading liquidations you witnessed overnight. The machines execute faster than humans can react. By the time retail traders were able to check their accounts, the institutional algorithms have already taken their capital and moved on. This is the modern battlefield. This is the silent war waged in the dark hours of the global trading day. And if you are not equipped to see the first strike, the DXY spike, you are not a trader. You are prey. Already taken their capital and moved on. This is the modern battlefield. This is the silent war waged in the dark hours of the global trading day. And if you are not equipped to see the first strike, the DXY spike, you are not a trader, you are prey. Look at the chart. The DXY printed a massive green candle at 2 RAM EST. That was the signal. That was the weapon firing. In that instant, every algorithmic trader on the planet received the same signal. Sell. Sell commodities. Sell precious metals. Sell anything denominated in dollars that moves inversely to the index. The orders flooded the market. Sell walls materialized at every key technical level. $115, $110, $105, $100. Each level was a trapdoor. Each level triggered a new wave of stop losses. Each stop loss sale drove the price lower, triggering the next cluster of stops. This is the cascade. This is the liquidation loop. The $100 level in silver was not support. It was fuel. It was where thousands of retail stop loss orders were clustered, placed there by traders who believed it was a strong round number support. The machines knew this. The institutions mapped this liquidity. They sold into it deliberately to trigger the avalanche. When the last buy order at $100 was filled, there were no more buyers. The order book hollowed out. The price fell to $95 in 11 minutes. In 11 minutes, leveraged long positions worth billions of dollars were wiped from the ledger. The capital did not vanish. It was transferred. Meanwhile, gold followed the same mechanical path. The DXY spike translated to a direct, inverse move in gold futures. The selling was not based on fear of gold. It was based on the mathematical certainty of a strengthening dollar. The equation is simple. DXY up, gold down. DXY up sharply, gold down violently. This relationship is the master key. All other news, geopolitical tension, mining supply data, ETF flows, is noise if you do not filter it through the dollar's strength. The dollar is the filter. The dollar is the lens. On January 30th, 2026, the lens focused sunlight and set the entire commodity market on fire. The press will spend the next week analyzing the reasons. They will quote analysts blaming surprise Fed commentary, unexpected macroeconomic data from Asia, or a sudden risk-off sentiment. These are stories. These are narratives constructed after the fact to explain a move that was already dictated by a currency chart. The truth was on the screen at 2 a.m. The truth was a vertical line on the DXY chart. The truth was the Japanese yen collapsing to a multi-decade low, boosting the dollar index. The truth was the euro stumbling on weak GDP data. The truth was in the forex market hours before the metal markets bled. Professional desks do not wait for the news. They trade the flow. They trade the currency move. They know that money moves from one asset class to another like water, and the pump that moves the water is the dollar. Last night, the pump switched to maximum suction, pulling capital out of metals and into cash dollars. This is the part they do not teach you. They teach you to look at a silver chart and draw lines. They teach you about head and shoulders, double bottoms, and RSI divergence. Useless. All of it is useless if a 2% spike in the DXY can invalidate every pattern, break every support, and shatter every expectation in 11 minutes. Your chart is a satellite image. The DXY is the live missile tracker. You're looking at a pretty picture of a city skyline while the warning sirens are blaring. You need to listen to the sirens. Let's break down the exact sequence from yesterday to this morning. Phase 1, New York afternoon. Initial DXY uptick begins. This causes the first leg down in silver from $121 to the $116 region. This drop triggers initial stop losses and creates panic selling before the close. The market attempts to stabilize. Phase 2, London close, Asia open. Liquidity thins. The major Western desks hand over control to automated systems. In this thin environment, a large institutional order to buy dollars against the yen executes. This is not speculation. This could be a Japanese corporation hedging, a sovereign fund rebalancing, or a macro fund initiating a major position. The size of the order overwhelms the available sellers in the USD-JPY pair. The yen drops precipitously. Because the yen is a major component of the DXY, the index rockets higher. The algorithms monitoring the DXY cross their critical threshold. Phase 3, the algorithmic avalanche. The sell signals are generated. Futures markets for silver, gold, platinum, and palladium are hit with a wave of sell orders simultaneously. The selling is not emotional. It is systematic, volume-based, and relentless. It continues until predetermined price levels are hit or until the DXY momentum stalls. Phase 4, the liquidity vacuum. As price plummets through major support, it triggers two critical events. First, it activates the massive pool of retail stop-loss orders, which become market sell orders, adding more downward pressure. Second, it forces leveraged long positions to face margin calls. Many cannot meet the calls, so their brokers automatically liquidate their positions, adding even more sell volume. This creates a self-feeding cycle. Price drop, stops hit, and margin calls forced selling, further price drop. This cycle is what took silver from $118 to $95 while New York slept. The machines fed on the liquidity provided by the retail crowd's automated risk controls. By the time the Asian session was at full volume, the move was largely over. The damage was done. The institutions that sold at $118 had already begun covering their short positions at $95, pocketing the difference. They provided the bounce back to $98, luring in bargain hunters, setting up the next trap. The entire event was a transfer of wealth from the unprepared to the prepared. From those watching price to those watching the cause of price, it was a clinical operation. And it will happen again. The conditions are not unique. The DXY will move again. The algorithms are still active. The retail stop-loss clusters still exist at new key levels. Your survival depends on one decision. Will you keep watching the silver chart, or will you watch the gauge that moves it? The financial press is now scrambling. Headlines scream silver crash and mystery sell of hammers, precious metals. They are looking for a ghost in the machine. There is no ghost. The machine is working exactly as designed. The connection between the dollar index and commodity prices is not a theory. It is an accounting identity. It is a function of global capital flow. When the DXY rises, it signals that global capital is seeking the safety or yield of the dollar. This often happens when there is stress elsewhere, in European banks, in Asian sovereign debt, in emerging market currencies. Capital flees those areas, sells local assets, and buys dollars. This dollar buying strengthens the currency. But this capital inflow into dollars does not sit in cash. It seeks a temporary home. Often, it floods into U.S. Treasury markets, driving up bond prices and driving down yields. This move in yields can trigger another set of algorithms that sell inflation-sensitive assets like gold. It is a chain reaction that begins in the currency market and ripples through every connected asset. The dollar weapon is not a metaphor. It is a description of this process. When the U.S. dollar strengthens rapidly, it acts like a global vacuum cleaner, sucking liquidity out of dollar-denominated assets that are perceived as riskier or non-yielding. Silver, with its high volatility and industrial component, is one of the most sensitive outlets for this force. It gets hit first and hardest. What most traders miss is the order of operations. The causal chain is Forex market, DXY move, interest rate expectations, algorithmic reaction in futures, liquidation cascade. Retail is focused on the last link, the futures selling. They try to fight it, buy the dip, and get crushed by the next wave of selling from the first link, which is still in motion. The DXY spike at 2:10 a.m. was not the end of the move. It was the beginning of a new impulse wave. The metal markets were simply catching up to a currency move that had already occurred. This is why the recovery yesterday evening was a trap. It was a technical rebound in a vacuum. The Asian session had not yet opened to provide the next wave of dollar buying. The DXY was consolidating, so metals bounced. This bounce convinced the retail crowd that stability had returned. They interpreted it as a V-shaped recovery and a sign of strength. In reality, it was the calm between two storms. It was the reload period for the institutional players who now had clearer visibility on the Asian order flow. The critical mistake is anchoring to a price. Believing $100 is a floor is a fatal error. In a market governed by currency dynamics, there are no price floors, only liquidity zones. Floors are psychological. Liquidity zones are measurable. The machines target measurable liquidity, not psychological levels. The $100 level was targeted because order book data showed a high concentration of resting stop-loss orders there, not because it was a round number. The next liquidation zone will be different. It will be wherever the next cluster of leveraged long positions has set its automatic risk controls. To survive, you must change your dashboard. Your primary screen must be the DXY chart overlaid with the yield on the 10-year US Treasury. Your secondary screen is the silver futures chart. This is the professional setup. They watch the cause, then observe the effect. They do not predict where silver will go based on silver's own patterns. They forecast where the dollar will go based on macroeconomic flows. And then they deduce where silver must go as a result. The narrative of industrial demand, green energy, and electronic consumption is a long-term thematic. It is fundamentally sound. But in the short term, it is irrelevant against a surging dollar. A 20% move in a day demolishes a year's worth of fundamental thesis. You cannot hide in fundamentals during a currency storm. You need a lifeboat, and that lifeboat is understanding the storm itself, the dollar. Look at the data from the crash. The moves in platinum and palladium were even more severe than in silver. Why? Because their markets are smaller, with less liquidity. When the dollar-driven sell program hit, there were even fewer buyers to absorb the order flow. They experienced a deeper, more violent collapse. This is not a story about individual commodity dynamics. It is a story about a small number of large connected pools of capital being moved simultaneously by a single factor. The aftermath is now setting the stage for the next move. Volatility has been injected. Leverage has been purged from one segment of the market. But the underlying condition, a volatile, spiking dollar index, remains. The market is now hypersensitive to the next DXY tick. The algorithms are on high alert, their thresholds potentially adjusted for higher volatility. This means the next move could be even more abrupt. Traders now face a choice. They can continue to trade silver as they always have, using traditional technical analysis on the silver chart, and remain vulnerable to these overnight black swan events that are not black swans at all for those watching the DXY. Or they can redefine their entire framework. They can start treating silver not as a standalone asset, but as a derivative of the US dollar. They can begin to see their P&L not as a function of silver's supply and demand, but as a function of Forex volatility. This shift in perspective is what separates the survivor from the victim. The survivor sees the January 30th crash not as an anomaly, but as a lesson in modern market structure. It was a real-time demonstration of power. The power is not in the hands of the bulls or the bears in the silver market. The power is in the hands of those who control the flow of the world's reserve currency. That flow is now the most important chart on your screen. For the retail trader, this seems like an unfair, insurmountable advantage. It is not. The data is public. The DXY chart is free. The relationship is clear and historical. The disadvantage is not information. It is priority. Retail prioritizes the asset. Institutions prioritize the currency that prices the asset. To bridge the gap, you must change your priority. The first question for any trade in a dollar-denominated commodity must no longer be, what is the chart saying? It must be, what is the dollar doing, and what is it likely to do next? The carnage of January 30th, 2026 will be repeated. Perhaps not tomorrow, but inevitably. The system is built for it. The concentration of algorithmic trading, the globalization of 24-hour markets, and the centrality of the US dollar create a perfect environment for these cascades. The only variable is the trigger. This time, it was a yen collapse. Next time, it could be a surprise policy shift from the European Central Bank, or a sovereign default rumor, or a massive quarterly repatriation of dollars by a US multinational. The trigger does not matter. The reaction does. The reaction is always a rush into or out of the dollar. And that reaction will always, without exception, hit the silver market with multiplied force. Your job is to see the rush coming, not to explain it, after it has already run you over. The mechanics are now clear. The DXY moves, algorithms react, liquidity vanishes, and a cascade begins. But understanding the how is only half the battle. The other half is the where and when. Where will the next wave of selling come from? When will the next trigger occur? This requires moving from reaction to anticipation. The institutional edge lies in predictive models that don't just track the DXY, but forecast its pressure points. These models monitor order flow in the Forex futures market, the commitments of traders' reports for clues on positioning, and real-time news sentiment analysis for keywords that move currencies. They synthesize this to predict volatility spikes before they happen. For them, the January 30th event was not a surprise. It was a high-probability scenario flagged by their systems hours in advance. The yen was showing extreme weakness. Forex options were pricing in heightened volatility, and the weekly positioning data showed speculative shorts on the dollar were at an extreme, setting up for a short squeeze. This level of analysis is accessible. The retail trader's failure is often a failure of context. They look at a silver chart in isolation. The professional looks at a matrix: DXY, US 10-year yield, the S&P 500, and the JPY-AUS USD exchange rate. This matrix tells a story of global risk appetite. When the S&P is down, yields are down, and the yen is falling against the dollar, it signals a flight to safety purely into US dollars, not treasuries or equities. This is the most bearish possible matrix for precious metals. This exact alignment was visible in the early hours of January 30th. The recovery trap was also visible in this matrix. The evening rebound in silver occurred while the S&P futures were slightly up and the DXY was flat. This created an illusion of normalcy. But the critical component, the JPY-USD pair, was still under immense pressure, just consolidating. It was a coiled spring. The Asia Open provided the catalyst to release it, and the entire matrix flipped violently back into risk-off dollar buying. The lesson is to stop trading silver, start trading the dollar matrix. Your entry signal for a silver trade should come from a convergence or divergence in that matrix. For example, if the DXY is rising, but US yields are falling sharply, a flight to quality within dollar assets, the selling in silver might be tempered. But if the DXY is rising and yields are rising, signaling monetary tightening expectations, the selling in silver will be explosive. This matrix provides nuance that a simple DXY up, silver down rule lacks. The aftermath of a liquidation event creates its own landscape. The market's memory is now scarred by the $95 low. That level becomes a new gravitational point. The high leverage speculative long positions have been cleared out. The market is lighter. This does not mean it cannot crash again, but it means the next crash may require a larger dollar spike to initiate, as there are fewer weak hands to liquidate. However, it also means the market is prone to sharp, short covering rallies if the dollar weakens, as sellers are exhausted. This new landscape is where the next phase of the battle will be fought. The institutions that profited from the short side are now monitoring for signs of a dollar reversal. They will use the same matrix to time their exit from short positions, and potentially their entry into long positions. They will front-run the next turn, just as they front-ran the crash. They will buy silver not because its chart looks bullish, but because their models forecast a sustained drop in the DXY due to, for example, a softening in US economic data or a coordinated intervention to support the yen. The retail trader watching the silver chart will see this buying as a new bullish trend and jump in. But the institutions will already be planning their exit, knowing that the dollar's weakness may be temporary. This is the relentless cycle. The only way to step out of this cycle as prey is to understand the tempo and the conductor. The tempo is set by global macro flows. The conductor is the US dollar. Therefore, the action plan is not complicated, but it requires discipline. First, place the DXY chart alongside your trading platform. Set alerts for moves beyond 0.5% within an hour. Second, monitor the USD-JPY pair. It is the most sensitive component of the DXY and often the canary in the coal mine. Third, before entering any precious metals trade, ask, what is my dollar thesis? If you do not have a clear, reasoned forecast for the dollar's direction over the next 24 hours, you do not have a valid trade. The events of the past 24 hours were a costly education for thousands of traders. For some, it was a final lesson. For others, it can be a turning point. The market has revealed its true engine. The question is no longer about the price of silver. The question is about the price of the dollar. Everything else is a derivative. The silver chart is just the shadow. Stop chasing the shadow. Watch the object casting it. In the global financial theater, the US dollar is the only actor that matters under the spotlight. All other assets are just the scenery, rearranged by its movements. The silence in the New York night was not an absence of activity. It was the sound of the battlefield being prepared. The Asian session was not a separate market. It was the other side of the same coin, where the pressure built and the dollar system finally found its release valve in the silver futures market. This is a continuous 24-hour war. There is no closing bell for the dollar. There is only a shift in which regiments are on the front lines. Your portfolio's survival depends on accepting this reality. The tools to monitor it are freely available. The relationship is unambiguous. The January 30th crash was not an act of God. It was an act of the market's most fundamental law, the law of currency pricing. It was a demonstration. The next demonstration is scheduled for the next time the dollar index decides to speak. Will you be listening, or will you be asleep? The path forward is defined by a single imperative: adaptation. The market that existed before January 30th, 2026 is gone. It was erased in the overnight session. What remains is a market with a heightened awareness of its own fragility. A market where the DXY is no longer a background indicator but the central protagonist. Your strategy must adapt accordingly, or it will be memorialized as a relic of a simpler, obsolete time. This adaptation involves dismantling old beliefs. The belief that physical demand sets the price. The belief that technical support levels are sacred. The belief that time frames matter. In a dollar-driven cascade, physical buyers are absent, support levels are liquidity traps, and a daily chart can be invalidated in minutes. You must rebuild from first principles. The first principle is that all global dollar-priced assets are expressions of a single variable, the relative strength of the US currency. Therefore, your analysis must invert. Begin with the macro currency view. Is the world currently seeking dollars or fleeing them? The answer is found in the confluence of bond markets, equity futures, and forex volatility. Once you have that view, the direction for silver becomes a high probability deduction, not a guess. This is not market prediction, it is market translation. You are translating the language of currencies into the language of commodities. The institutional algorithms are doing this translation instantaneously. Their code is a series of if-then statements rooted in this exact principle. If DXY breaks above moving average X with volume Y, then initiate short position in silver futures with size Z. Their success is not due to magic, but to the rigid application of a causal rule. You cannot outcode them, but you can adopt their foundational rule. You can manually execute what they automate. Your edge becomes your understanding of why the rule works, allowing you to anticipate when it might be overextended or when a counter rule might apply. Consider the aftermath. The market is now in a state of shock, but shock dissipates. The volatility will compress. The DXY may enter a range. This is the most dangerous phase for the reactive trader. It is the phase of false signals and whipsaws within the silver chart itself. This is when traditional chart patterns will appear to work again, drawing in the crowd once more. This consolidation is not a reset to the old ways. It is the gathering of energy for the next major dollar move. The professional uses this time not to trade silver's minor fluctuations, but to analyze the positioning in the dollar for clues to the next breakout direction. Your screen setup must reflect this new hierarchy. The largest window should display the DXY with key moving averages and volume. A smaller window should show the USD, JPY, and EUR USD pairs. A third window can monitor the silver futures. This visual prioritization physically trains your brain to process the cause before the effect. Your trading journal should not start with silver was at support. It should begin with the dollar was showing strength due to... This reframing is critical. The psychological shift is heavier than the technical one. It requires admitting that much of what you've learned was secondary. It requires embracing the discomfort of focusing on an abstract index rather than the tangible asset you're trading. It means finding conviction not in a pretty bullish pattern on silver, but in a dry analysis of forex, order flow, and central bank balance sheets. This is where most will fail. They will intellectually understand the DXY's importance, but emotionally default to the familiar silver chart when real money is on the line. The final barrier is time. The dollar moves 24 hours a day. The most decisive moves, like the one witnessed, often occur during off hours for Western retail traders. This is not an accident. It is a feature of a global system. To survive, you must either become a 24-hour vigilante of the dollar index, or you must employ strict automated guardians, stop losses, and alerts, based on DXY levels, not silver price levels. Your protective orders must be tied to the source of the risk, not the manifestation of it. A stop loss at a dollar index level of, say, 105.50 might be far more effective than a stop at a silver price of $100. January 30th, 2026 was not the end. It was a loud, violent proclamation of a reality that has always existed. The silver market has always been a satellite of the dollar. The difference now is the speed and amplification provided by algorithmic trading and interconnected global liquidity. The proclamation was a gift wrapped in devastation. It laid bare the entire game. The weapon was shown, the trigger was pulled in public. The only remaining mystery is how many were watching, and of those, how many have the will to act on what they saw. The narrative ends here. The next chapter will be written by your actions. You can close this transcript and return to watching silver candles form, waiting for the next unexplained plunge to take your capital. Or you can make the switch. You can turn your attention to the 3 letters that control it all. You can start watching DXY. The choice is binary, just like the outcome. Survive or be liquidated. The market no longer offers a middle ground.